Hello, my name is Sergio Marrero, and we are here at RBL1 Live. Today we have a special guest, Miriam Rivera. She is Managing Director at Ulu Ventures, a seed fund that invests primarily in enterprise IT. And she is definitely known in the venture capital space among the Latinx community, and a leader I admire. So thank you for joining us tonight, Miriam.
Thank you for having me, Sergio.
Of course, of course. So I wanted to dive in and share a little bit more about Miriam. She's on the board of trustees at Stanford University. She also board of visitors, Stanford Law. She used to uh, be at Google. She's on the board of the Kauffman Foundation. So she's super prominent and connected, but really setting the stage. I'm excited to dive in and hear more about Ulu Ventures and the unique aspects that you've put in place to really raise the field of venture capital. So with that, can you share a little bit more with the audience about what is Ulu Ventures?
Yep. So you mentioned that we're a seed stage focused fund, and that means that most of our companies are just starting out when we invest. There's probably something like 2 to 6 people working in a company. So a big part of it is proof of concept technology, a small team, maybe some pilot customers, and they're typically working with enterprises in one way or another, either as a B2B strategy or B2B2C. And those are kind of the major ways that we invest in companies. The other thing about Ulu is that we tend to focus on diverse teams. And by that, we mean that we especially encourage teams that have underrepresented minorities, women, other people of color, Asians, for example, and also immigrants to look for funding from our firm. And about 78% of our firms actually have somebody with one of those characteristics on their team, which still means that the majority of the entrepreneurs are white men, because we have tech companies that are enterprise focused, and that's kind of the biggest part of the employment population. But we are really represent demographically the sector.
That's great. And when you're and what size like checks are you writing, or can you share a little bit more? Is there a geographical focus beyond enterprise IT?
Yeah, so I'd say the majority of our investments are in the Silicon Valley, but we have investments in New York, Atlanta, other parts of the East Coast as well. So a lot of it depends on the time, just what we see at a given time where we're going to actually invest, but the bulk in California and Silicon Valley. And in terms of other things that are special in terms of areas, we're very broad. We're a generalist firm, so we have investments in ed tech, legal tech, fintech, future of work, so technology-enabled services, quite a lot of diversity in terms of the areas we invest in. One thing that's kind of a thread behind them, though, is that they usually use data to help make businesses more efficient, effective, and or inclusive.
That's great. And and can you share a little bit more about how did you come to start your own fund? I know Ulu Ventures, you've been working on it for a while, but did you always know you'd be in venture, or how did you end up here?
No, I probably never thought I'd be in venture. It would be more to the point. So I came to Stanford on a full scholarship, and I was a first generation college graduate. So I never heard the word venture capital. Probably, even though I went to Stanford undergrad, my focus was on working in more the helping profession. So I was doing advising and counseling with students at the University of California and Stanford before I went back to law school and business school. When I went back to law school and business school, I was essentially recareering. And at that time, I started understanding the technology industry here in the Valley, did internships over the summer. And one of the things that I saw was one of the law partners at the law firm where I interned left to go to a venture capital firm. And we were working in part on startup companies and venture capital firms' legal matters. And so I started becoming familiar with what is it that VCs do while I was still in school. And I kind of tucked that at the back of my mind. I took classes in it because I knew I would be working with startup companies, but had not had the exposure, so didn't think I would do it long term. Ultimately, when I was at Google and I was kind of looking for what's my next opportunity, I thought that venture capital would combine a lot of the business and the background that I'd had in the legal side of venture capital, and that it would also give me a platform to increase access to capital for people of color. Because what I saw was that VC was not reflecting the people that I was hiring in Google or the people that were helping make that company successful. And I thought there was a real disconnect.
And can you share a little bit more about having a business, having going to undergrad, getting a legal background, going into a tech firm, what from the legal background helped you in venture capital?
Okay, well, and it's both law and business because I did a joint degree and
Okay.
did my MBA as well. And so, in terms of the law, what helped me was I had really gone and negotiated these venture deals as an attorney before I even went to become a startup founder myself. So that gave me background in terms of like what are these things that people negotiate, what's a liquidation preference, all of that sort of stuff I had basically through practical experience working on behalf of clients. And then in terms of going into a startup environment, I was a startup founder in what are kind of, from my point of view, they were kind of bad old days. So when I did a startup, I was doing it with my husband and three other founders. And when we got the Series B, the investors didn't want a husband and wife team. So I was basically asked to leave my startup. And I think that now there's a lot more teams that have husband and wife, brothers, family members working together. And we have some of those in our portfolio. I don't think it would have been the same thing, but having had my first child when I was a startup founder, I had her on Friday, went back to work on Monday, but within a couple of months, I'd basically been asked to leave.
And can you talk a little bit about that? I know for one of the first deals that I pushed forward was a couple, right? And we debated, of course, the pluses and minuses of that. Can you share a little bit of your insight, having been on both sides?
Yeah, well, and there are pluses and minuses. It's a more complicated working arrangement than is the case with people who don't have a family relationship. And anybody who's got a family knows why, right? It's like emotions run stronger in a family than they do, with just somebody you don't really care that much about. And so I think there's definitely ups and downs that you have in a firm where you have family members working, and that includes siblings. But I also think that you have a higher level of investment in the success of the people and the firm because it is important to a family. And for us, I know Clint and I, between the startup and Ulu Ventures, have been working together almost 15 years out of our 23-year marriage. So I think that different people might not be able to enjoy or get that, but for us, it's really worked because I think we bring a lot of complementary skills and a real deep passion around entrepreneurship.
That's great. I no, really admire that because when you dive in and look at many of the businesses, not only in the U.S. but beyond the U.S., most of them are family businesses, right? So it's interesting to look at tech businesses and then have that bias of have that bias that if there's family involved, you're not going to invest because you'll just eliminate a set of investments that may be great deals. But going back to what you talked about in being in the first part of the journey, saying, hey, how was that? How did that decision unfold when you were asked to leave? Do you think that 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 in general we just need to be more flexible, as investors, or do you think that um, we should be more flexible in supporting, like, couple founders, um, or should we like manage them to be more independent? Like, I don't know if you have opinion on that.
Yeah, I mean, I think anytime you have family members working together, you have to be supportive of the family, and you have to try to implement, really strong communication. And I think there is a level of flexibility. We hear from some of our teams that are brothers, for example. They also sometimes have issues, right? And I think the main thing is, certainly a couple that's been together longer probably has weathered more together, right? And like Clint and I got through that, right? A lot of founders that have a breakup stop being friends. But again, there's a higher level of investment in a family than there is in a friendship. And so we got through that. And I think that for us, it really helps us to empathize with our founders around some of these issues. And for us, we've developed a lot of mechanisms that we think are helpful to keeping a relationship going outside of work, which I would recommend even to partners that are not married to each other, because I think that part of the investment that a couple has is trying to improve their communication, making time that isn't work time to actually build relationship with one another. And you do this in a company setting, like at Google, we used to do a lot of team building exercises, and they were really fun things. But a lot of the times when you're in venture, you get so busy and you don't necessarily actually make time to build that relationship with your partner. And when times get hard, conflicts can arise. But if you have more goodwill in your bucket, in your relationship, that's going to help any business. And so, I think we've just been more conscientious about trying to implement ways that support our relationship and our family, because we know that there's so much more at stake than even just the business.
Yeah, love that. Thank you for sharing that. I want to shift back to also the Ulu Ventures, and I know that both of you have worked to make diversity, and not diversity for diversity's sake, but great business, looking for great businesses, but also that is part of your investment thesis. So can you share a little bit more about how Ulu thinks about diversity?
Yeah. So my intuition or my lived experience with diversity was that it tended to create really high performance in organizations. And I saw that in particular when I was at Google. I thought that the outside world did not credit the diversity that we had in the early days with this part of the success of the company. And I'll say that almost every important team in the company had a male female head. And so if you think about the company as a whole, Eric Schmidt's right-hand person was Sheryl Sandberg. Larry Page's right-hand person was Marissa Mayer, who's the former CEO of Yahoo. Sergey Brin's right-hand person was Susan Wojcicki, who's the current CEO of YouTube. And in the legal function, David Drummond's right-hand person was me. And so that dynamic of having that difference in the teams, I think was really important to us operating really effectively. And that, there really was a way for people to share work, responsibility, communication in a way that was more effective and was necessary, if you will, because we were one of the fastest growing companies in the history of the United States. And so, just expecting one person to basically do everything, like David Drummond had 4 different departments he ran, that was a lot for anybody to do at that sort of clip of growth. And so I think that was an important factor. And then even just in the original 13 VPs, we had 3 women, we had 2 immigrants. Sergey Brin was the son of immigrants. And the first general counsel was African American, and the first CFO was Cuban American. And I think that helped us to be more successful because we were a global business going after a clientele that spoke all the world's languages. And one of the first questions that we were asked when we joined was, what languages do you read, speak, and write? It was considered an asset, not a negative, that you had a different culture, a different language, because those were our customers. And in legal, for example, we would bring in attorneys that were multilingual or bilingual and could read, speak, and write in the language of the countries that we were doing business with, because, hey, that makes us work faster. If people can understand each other and, they can't understand the English agreement, we can explain it in Spanish, Portuguese, Japanese, whatever language, Chinese, Hindi. That was making us one of the fastest growing companies ever.
I think that's beautiful. The way I think many people think of it as, oh, it's an exception or it's a nice to have. We talked about quotas the other day, and I said it's just an asset, right? You're looking at the whole package of the team. The team has to perform and be nimble and adaptive. Having experience as in another culture, another sex, like whatever it may be, gives you insight to that type of customer, how they may live and work, and how to serve them better. So I thank you for that.
Total competitive advantage when you want to build a global business.
Absolutely. Absolutely. And for you in making investment decisions, how are you making sure that your portfolios are diverse, and as you build out the Ulu Ventures?
So one thing, there's kind of diversity builds diversity. So one thing is that it is really helpful to have a diverse team within your venture firm to be able to access diverse deal flow and diverse networks. And part of that, people don't appreciate how much time and effort it takes to build networks. And if you think about your own life, and I think about mine, I know that I started being part of diverse groups in high school, right? Like when we had, even in my middle school, there were 60 different languages read and spoken at home. And so I know that it was just a diverse community that I grew up in. And I think that's always been a part of who I am, and the awareness of so many forms of diversity and intersectionality. But in high school, I started like officially joining clubs that would be like women's clubs, Latino clubs. At the high school that I went on a scholarship, I was part of an African-American club because there were no other clubs for the rest of us, right? So we were basically building diverse networks for 40 years, right? And then when I became a professional, I was in those kinds of clubs, both in the law and in business, and in venture capital. So unless somebody is specifically trying to build a network in a super conscious way, they're probably not going to do that level of building a community. And so for me, that's been an advantage in terms of sourcing deal flow. Now, once the deal flow is in my pipeline, we're trying to actually measure at the different points in our decision making. Are we bringing people in for meetings? When they get through that, are they getting invited to do what is our big diligence step, which is called a market mapping? And then when they go through the market mapping, are they coming out the other end and receiving investment, right? So part of it is just measurement. It helps us to see if we're not doing what we say we're going to do. And then in terms of our market mapping process, we're trying to develop a sense of the market opportunity for a particular company. And that's a collaborative process where we have like our best people, the company's best people, we're all in a room and we're coming up with that analysis together. And then we share that with them, whether we make an investment or not. So they get to have the models, they get to have the what if scenario planning that model enables. And they get to have this work on their story that they get to take with them to the next place they pitch.
That's great. And can you share a little bit more? I know we had spoken previously about the work you've done around unconscious bias. Can you share with the audience what is unconscious bias and how it can come into play in the venture selection process?
So there's kind of two forms of bias that our processes are designed to reduce. right? Because we all have bias, implicit and cognitive biases. And so cognitive biases are the ones where you do something that doesn't really make any sense. And when somebody shows you that it doesn't make any sense, you think, oh my God, how could I have, done this dumb thing? Like sunk cost thinking is one of those, right? Where you could make an investment and just keep investing in something that's like going to keep losing you more and more money. And, if you're kind of aware of the concept of sunk costs, you then make a decision fresh so that you don't throw good money after bad. Because you now have more information, you can make a better decision. But then there's implicit biases, which are biases that are subjective and often can center around people's personal characteristics, for example. And so it may be that, we've all heard the story, for example, of a child goes into the hospital and the doctor says, I cannot perform the surgery and because there's a conflict, and everyone thinks, well, it must be the kid's father. That's the doctor. And implicitly, you're thinking that a doctor is a man, but it's his mother. That's the punchline of the joke. And so those are the kinds of implicit biases that walk into the room with a VC and an entrepreneur. And some of the ways that it shows up, for example, there's reports, research that's been done that shows VCs ask women questions more about the downside of their business than about the upside of their business. And when people focus on that downside risk, the amount of investment that you're going to get is way lower than when they focus on the opportunities. And that's one of the reasons why you see that the number of dollars invested in women is 2% compared to the number of investments in women being closer to like 11% in venture capital, right? Because we're going to invest, but it's going to be a lot less because we think it's riskier. And a lot of that risk stems around the fact that they're women as opposed to men. In addition, there's studies that show people give you more positive feedback if they feel like you're in an affinity group with them. So if you happen to be a short Asian man, you're probably going to get a lot less positive feedback from a white male investor than you would if you were tall and white and more similar in background. And that could be, things like positive smiles, shaking your head, engaging in questions, those kinds of things. So there's a lot of implicit biases. And part of what we do is to focus on breaking down the opportunity of a company into much smaller pieces where we're gathering data that as much as possible is objective, but then we're also taking into consideration our subjective sense of what that company's success is going to be on factors like financing risk, team risk, product risk, and market adoption risk. And we're breaking that down, though, between the short term, the medium term, like early stage success, crossing the chasm, later stage, and then kind of market leadership. So when you break it down into smaller pieces, your biases against the people are broken down in ways that, one, you record and it helps you to learn in the future. When you see whether that company succeeded or not, you can learn whether your estimates were good or bad. And that's something that I think a lot of VCs don't have written down systems that include their subjective opinions in a way that helps you to quantify and learn in the future whether your predictions are accurate or not accurate.
I think you gave a great example of what you do to mitigate the bias. Are there other tips when you talk to other investors that the investors that may be listening that are trying to mitigate bias in their own process? How else would you recommend they do that in considering investments in early stage ventures?
Well, some of the things that we recommend are to have really transparent criteria and not to change your criteria. A lot of what's interesting is, for example, people will talk about who's qualified or unqualified, but when you use exactly the same criteria, even if the people are equally qualified, implicit bias makes it so that you don't see them as equally qualified. And so, for example, there was a study that was done, National Academy of Science study done by Stanford Spark Center and Illumin Capital, which is a fund of funds that's run by Darren Dodson, an African-American gentleman. And that study essentially sent out the overview of a fund. And guess what? The real difference was just the picture, whether the person was white or black. And if the white or black resume or a bio of that fund was exactly the same, the white people would get more interviews to come in for a potential LP investment, and the black person with exactly the same qualifications would get fewer. So it, really is the case that our biases reduce even objective information. So, one thing is to just go on the basis of the numbers actually helps. If you see that people have a same track record, why aren't you calling them in? And this is kind of akin to another change that happened with the violinists at orchestras, where it used to be that supposedly only men could be violinists, first violinists, because they were just so much better. But when they put people behind a curtain and couldn't see that it was a woman playing violin, the composition of the first violin chair changed dramatically in the orchestra.
No, that's a great example. You had just mentioned LPs, so limited partners, those that give invest in venture capital funds. Well, or venture capital funds are investing their capital on their behalf. Can you share your insight into in diversity in fund managers like yourself? Like what are things we need to do to increase the number of diverse fund managers?
Well, that's a big
it's a big question. I know.
Well, one is obviously there's some things that we need to do ourselves, right? Like I think we're increasing the rate of our education, dramatically, in particular in the Latino population, and the white population's education is actually declining. So as those kind of things intersect, it should help, but it's not sufficient, and part of that is still trying to develop practical experience and networks in the field. So that's on the side of prospective VCs themselves. And I think we're all needing to try to create more opportunity. Like this summer, for example, we did hire an intern for the first time. And that, I think, and he's a Afro-Latino from the Dominican Republic, from New York. And we're really trying to be aware that even as a small firm, that we can make a difference in terms of somebody getting more experience in the field. So to all of us that have the ability to hire an intern, hire somebody part-time during school, I think that's the kind of thing that we do on that side. For LPs, I think there's something different. And we see LPs kind of going through their own process of trying to educate themselves about diversity and trying to address their own implicit bias. I will say that when we raised our first institutional fund, which was Fund 2 in 2016, diversity was a page in our appendix. We did not go to market with that story on a deep level unless somebody wanted to talk about it. And part of that was there wasn't a lot of interest from LPs about diversity, because if anything, the implicit bias is that if you invest in diverse managers, that's going to perhaps lower your return. And I think part of what we're learning through the data now is if it turns out that fund managers who are diverse invest in more diverse teams, but those more diverse teams are performing higher than less diverse teams. And so I think as this learning goes on, LPs are going to realize that the implicit bias is false, the data is against them, and they're actually accepting lower returns than they would have if they were investing in diverse managers and diverse entrepreneurs.
And I know right now, Ulu Ventures, you guys are raising. What are you hearing? what else are you hearing on the street in terms of what limited partners are looking for to those other if, emerging fund managers that are out there knocking on the doors of LPs, especially now in the time of COVID and everyone seems paused in terms of allocating capital. Can you give a little insight into the environment and the mind of an LP?
Yeah, I will say that Q1 was pretty dead on the LP front. And part of that is because they, like venture capitalists, were really focused on their existing portfolios and trying to assess the underlying risk in their portfolios. And so, we were huddled with our companies, trying to make sure they could all survive, or as many of them as possible. And then they were trying to understand like what was happening in the positions of their portfolios. So that was really dead. And this quarter, though, we feel like there's been a big revival as people realize like still their job to invest people's capital, and they typically have a real duty to invest that capital, right? Because a lot of these funds are pension funds, or they're funds that significant investors have put capital towards, and they're expecting it to be placed. And in fact, a lot of the times, down markets are a really great time for institutional capital to be investing in fund managers, because the underlying assets in those portfolios typically are valued less highly than they have been in a 10-year bull market. And just that will increase returns, right? And so we're seeing a lot more activity now from LPs. We're also finding, before it was an appendix, now it's something that we are very clearly getting positive feedback on our diversity in our portfolio, and of course that's based on the fact that our results are really good. And again, that's because we think it's going to lead to outperformance, and that's what we find to be true. And the other thing is just that we see more LPs who are trying to at least start doing research on how they can place money with diverse managers, how that's impacted the portfolio of other peer LPs. And the data is coming back positive. So this week, Cambridge Associates, for example, put out an article about their diversity activities. And one of the citations they mentioned said that of diverse managers, 39% are in the top quartile. So there's a nice pool of managers that are achieving top quartile returns, which is exactly what most of the bigger pools of capital want to be seeing.
And when you're looking at the typical performance of or the typical focus of venture funds. So I know a lot of emerging fund managers, they end up starting smaller funds first, right? To kind of prove their track record before they go off. And then you have larger limited partners, let's say pension funds, endowments, that they don't really write these smaller checks. So there's a mismatch. Do you have an opinion on what they can do to still diversify their base if just those emerging fund managers may not be as big enough for them yet, right? Like, do they have to innovate? Do these emerging fund managers have to ask for more? Like, what do you think needs to happen there?
So I think that first I'll address the LP question, because I think that's frankly the easiest one I think LPs need to innovate on their model. There's so many investors that will say, we don't actually invest in funds under $300 million or $250 million, whatever the number is. And by saying that, they pretty much eliminated almost all the diverse funds that they could invest in. And so I think part of that is making them aware that that in trying to be blind to the principle of where their money goes, they're actually very much impacting the capital formation ecosystem. And so some of the things that I've seen are educating themselves as LPs about how diverse investing has impacted the funds of peers. So for example, the Knight Foundation has invested nearly half of its corpus in diverse managers, and their results are still great, and so it's basically like, actually do your research, understand the bias and learn that the bias isn't true, and then go and try to find those top quartile performers that are smaller. And then some of the ways that people are doing that are to create dedicated pools, but they also need bridges into their regular pool, right? Because sometimes they'll have a fund that's just for smaller funds or diverse funds, and they'll start off with a $5 million investment, even though they're tens of billions of dollar pension fund. And then they need to have a bridge for when that firm gets to be big enough that now they can go into the mainstream portfolio. Another group that we know that's a fund of funds has taken an allocation from its portfolio, like let's say their typical bite size is $30 million. Well, they've taken that and broken it into 6 allotments that they would do into smaller managers, so that they actually can invest in more diverse teams, and they can, over time, see which ones of those can grow into the mainstream portfolio.
That's great. I mean, those are great examples of how like the LPs can innovate. What should the emerging fund managers also be doing to better meet the needs and of these, and engage, maybe in some cases places that aren't traditional LPs?
Yeah, so one is this, one of the business reasons why this is such a hard business is because the time horizons are very long. Like, we thought we would invest at seed because that's where we could put to work smaller dollars, which is what we had without LPs. If we had smaller dollars, so we put together a $3.5 million fund for our fund one, and that was a great place to invest. And what it did was to show that our selection is really strong, and that we could identify companies that became worth $1 billion out of that small fund. Then we had to go and try to raise additional capital. But part of the hurdle is the notion of track record, and if you don't have enough time to actually generate the DPI or the sale of companies or the IPOs, which are taking, on average somewhere between like 8 and 12 years, then you're going to have a harder time arguing on the basis of track record. So we've tried to also argue that LPs need to look at interstitial kinds of metrics, like follow-on rates, for example. So like, let's say our companies receive investment at a rate that's 3 times the average for other funds of similar size. And so that's the kind of data that I think they need to be looking for as an indicator of value early, before somebody can really have a full track record with cash on cash return.
That's great. Especially, that's what I was going to ask about as well. Because right, I talked to one family office, and they said, oh, we like to invest in the second or third fund, right? And then they want you to have experience of working at another fund that for call it 3 to 7 years before, doing the same strategy that you've executed in fund one. So you think about, like, in terms of flexibility of experience, it says, okay, you just outlined like 10 to 15 years of working on a very similar strategy, and that's what you want to invest in. And I get that in terms of de-risk. What are other ways, as you mentioned before, what are other ways to showcase that you may not look the exact template, right, of what they're used to funding, but you have the acumen and the capability of making good investments?
Yeah, and one thing I will say, there are some good reasons for why LPs are so focused on this, and one of them is that only 10% of funds actually raise a fund 4. So the huge majority of them will actually never mature into a mature fund. And so that is one of the reasons why, people want to sit on the sidelines until you're a proven success, and then they want to jump on your bandwagon. But I think the things that can help are both having, for example, a proof of concept portfolio to the extent you're able to finance that. So, you can have a smaller set of companies, even potentially at smaller dollars, but that are indicative of the kind of investment portfolio that you can generate as an investor. And so that is another thing that we did, right? We had an angel investment that had done very well. We cashed out a part of that investment. So we had $1 million, and we took that $1 million and we made 9 positions. And that proof of concept portfolio, I think, indicated the quality of investments that we would continue to make in the fund 2. And that was really helpful. And it turned out that particular vintage has really outperformed. So like, instead of 3 times the industry average follow-ons, that cohort got 4 times the industry average. So again, that was another indicator. And so a lot of this is about trying to measure the things that you can measure, trying to create the kind of portfolio that you can, and then, trying to tell the story in a very logical way that honors the fact that your LPs have a reason to be risk averse with the funds 1 through 3, but gives them data to say, I'm going to be different, and I do have to say, like, at some level, you really have to just keep on doing the thing you want to do, even if others are not believing for a long time. And I remember when Clint and I had been in business, and maybe we'd been in business 4 or 5 years, and we'd done pretty well in terms of like results and follow-ons. But we went and talked to a lot of fund of funds because people said, oh, you guys are doing great, so fund of funds should be good initial investors for you, along with maybe wealthy individuals, but the fund of funds have more money, so go talk to them. And what we were told is, oh, nobody will ever invest in you because you're a husband and wife team. They just said straight out, like, well, we would never invest in you because you're a husband and wife team too. And so initially we were pretty discouraged. In fact, we thought, well, we actually went and looked at other startups and joined other startups for a time. And then we got pissed and we said, we got to come back because we're really good investors and we're really good together. And, just because we're a husband and wife team, if people are going to discriminate on that basis, well, they're not our LPs. And we went back to the market, and eventually in Fund 2, we were able to get a university endowment, a college endowment, a fire and police pension, a sovereign wealth fund, so somebody believed in us and still do, because almost all of our LPs have also invested in Fund 3.
Love it. I think, I'm gonna pause there and say thank you, Miriam, for sharing that personal story. Especially, I think that's the perfect ending to show. Sometimes you just have to go at it. So definitely inspiring at work that you're doing at Ulu Ventures. So everyone watching, thank you for joining us tonight. This was RBL1 Live, and we were here with Miriam Rivera, Managing Director of Ulu Ventures. And come join us Tuesdays and Thursdays at 7 p.m. Eastern Time to listen to more amazing investors like Miriam. So thanks again for joining us.
Thank you, Sergio. It's been a pleasure to be with you today.